Shark Tank fails that became big successes. Hey guys, today we're going to talk about Shark Tank fails that became big successes. Let's get right into it. Number 1. Toy-Guru. It was for two major reasons, according to founder Phil Smyth, with whom we spoke in depth about Toy-Guru. To begin with, sourcing prices were difficult to come by. They expected their newfound investors to assist them with Mattel contacts, but nothing came of it. Second, shipping costs would be prohibitively expensive due to the toy's disparate dimensions. This was an issue because they used a free shipping model. They wanted to leave to deal with the problem, but their newfound investors were opposed. According to Phil, the company would have been much better off growing slowly and organically, giving them more time to deal with some of the sourcing and shipping issues we discussed earlier. This, combined with the lack of agreement and the shipping issue, led Phil to believe that participating in Shark Tank was actually detrimental to the business. Overall, Toy-Guru demonstrates that Shark Tank is not always a home run for the contestants. The free publicity may arrive at an inopportune time for the business, and the relationship with the investors may deteriorate. Number 2. Show No Tells. Shelley Eller and Lori Grenier's relationship suffered right from the start. Grenier, according to Shelley, warned her not to cash the check the next day and later attempted to change the terms of the deal. Furthermore, the company had a lot riding on a big deal with Disney. After months of attempting to move the deal forward, the deal fell apart due to insufficient online sales and a profit margin insufficient to meet Disney's expectations. Another deal that failed was a royalty agreement with Franco Manufacturing. The failure of both deals, as well as the conflict between the founder and the investor, resulted in the company's demise. Shelley Eller is back in business 3 years after closing Show No Tells. She relaunched the website and is now selling the tells primarily to people with disabilities, a market Lori Grenier did not believe was large enough to pursue. Number 3. Sweet Balls. Sweet Balls' story is a classic tale of two founders feuding. Soon after the Shark Tank deal was made, James McDonald and Cole Egger filed a lawsuit. McDonald was suing his partner because he suspected he was developing a competing product behind McDonald's back. Egger began operating the competing Cake Balls brand. Things between the two partners became so tense that a restraining order was issued. The problem was that the conflict between the founders occurred shortly after the Shark Tank episode featuring the product aired, resulting in a significant missed opportunity for the company. The site was unavailable, and the Sweet Balls domain was briefly redirected to Cake Balls' website. Following the conclusion of the lawsuit, the Sweet Balls website will be returned to James McDonald, the original creator of the Sweet Balls brand and product. However, with the missed Shark Tank opportunity and the passing of the Cake Balls craze, the business is not doing well, and McDonald only runs it as a side gig. Number 4. Body Jack. Barbara Corcoran told Jack Barringer on the show that in order to finalize the investment deal, he needed to lose £30 to prove the machine worked. He did so, and the transaction went through. However, the business did not succeed after that. The website selling the product was discontinued in 2012, and Corcoran mentioned in interviews that investing in this company was the worst business deal she had ever made. There is no public information available about the exact reasons for the business's failure. Number 5. Kate App. The Kate App received 10,000 new downloads after the episode aired. The majority of the new customers were women. Neil investigated those markets because the app's privacy functionality could also be useful for government and law enforcement. However, it appeared that the app did not gain enough traction because it went offline, and the last post from its social media accounts was in 2013. Number 6. Breathometer. The concept sounded fantastic, as evidenced by the fact that all 5 sharks wanted in on the action and invested together. However, the company encountered numerous issues following the transaction. They were having difficulty fulfilling all of the orders they were receiving, and it was soon discovered that the device did not work as advertised. The device's results were inaccurate, and it occasionally reported a blood alcohol level far below the actual value. This is a major issue because it may encourage people to drive when they are not physically capable of doing so. The Federal Reserve Commission intervened and ordered Breathometer to refund all of its customers in full. Mark Cuban called it the worst execution in Shark Tank history and blamed the founder for mismanaging the capital. Despite this significant failure, the company is still operational. Number 7. You Smell Soap. Megan Cummins tried unsuccessfully for 6 months after the on-air handshake deal to contact Robert Herjavec. After doing his due diligence, he returned with an adjusted offer of $50,000 for 50% of the company, which Megan turned down. As evidenced by the Show No Tell deal, a change of heart on the part of the Sharks is not uncommon. Of course, they have the right to change their offer after conducting their due diligence, but the 6-month wait with little communication before making a decision and committing is a major issue in and of itself. For a new business in desperate need of funding, a quick no is preferable to a delayed maybe because of a recent appearance on national television. That's all for today, and we'll be sure to catch you all in the next one.